While most people were distracted by headline inflation prints, election noise, and daily market swings, something far more structural shifted in the background. Global banks began reducing their exposure to US dollar liquidity, not through dramatic announcements, not through panic, through balance sheets, funding desks, and quiet changes in how much capital they are willing to park inside the US financial system. The core event is simple in one sentence. Non-US banks are shrinking their dollar funding footprint at the same time the US is demanding more of it. This matters because the modern global economy runs on dollars. Roughly 85% to 90% of global trade is invoiced in USD. An estimated 13 trillion in dollar-denominated liabilities sit outside the United States. European, Japanese, and emerging market banks are the plumbing that moves those dollars. When they step back, even slightly, the system does not slow, it tightens. The crowd misses this because it doesn't show up as a crash. It shows up as basis spreads widening by 20-40 basis points. It shows up as FX hedging costs quietly rising from 1.5% to 3.0% annualized. It shows up as repo volumes thinning by a few $100 billion over months instead of days. These are institutional signals, not retail ones. They don't trend on social media, but they change how credit flows. The forcing mechanism is the collision between three pressures: high U.S. interest rates, with the policy rate in the 5% range and Treasury yields oscillating between 4% and 5%, holding dollars is no longer free. Funding them costs real money. Balance sheet regulation. Post-crisis rules like Basel III and leverage ratios penalize banks for expanding dollar assets without matching capital. Every additional $10 billion in U.S. exposure now consumes scarce regulatory capacity. Currency risk. For a European or Japanese bank, every U.S. asset must be hedged. When the cost of hedging jumps from 1% to 3% annually, a 4.5% Treasury yield effectively becomes 1.5%. At that point, the trade stops making sense. Now here's where it breaks. The U.S. economy depends on continuous foreign participation. Foreign institutions hold roughly $7-8 trillion in U.S. treasuries. They fund a significant share of U.S. corporate credit, commercial paper, and cross-border trade finance. If even 5%, 10% of that participation is withdrawn or allowed to run off, that's $350-800 billion in liquidity that must be replaced domestically. But domestic balance sheets are already stretched. U.S. banks are carrying higher capital requirements, absorbing rising Treasury issuance, often $1.5 to $2.0 trillion per year, and managing deposit bases that are more mobile than at any point in history. They cannot simply absorb a global pullback without repricing risk. This is the part most people miss. Liquidity doesn't vanish evenly. It concentrates stress in specific channels: short-term funding markets, FX swap lines, trade finance, and regional credit. The consumer may not notice it immediately. The market does. What's at stake isn't a headline crash. It's the cost of money itself. When dollar liquidity tightens globally, everything priced in dollars: energy, food, freight, debt, reprices. That can mean higher inflation abroad, slower growth at home, and policy choices that become increasingly binary. Either rates stay high and global funding fractures, or rates fall and domestic inflation risk returns. This material is for educational purposes only. It is not financial advice. Economic systems involve uncertainty, risk, and nonlinear outcomes. Always consult qualified professionals before making financial decisions. To understand why this quiet pullback matters, you have to see how global dollar funding actually works. Most dollars used outside the United States are not physical currency. They are balance sheet dollars, created when banks lend, swap, repo, or clear transactions. A German bank financing an Asian manufacturer in dollars is effectively printing offshore USD through its own funding channels. This system functions only if banks can cheaply obtain and roll short-term dollar funding. There are three primary pipes: FX swap markets. A foreign bank borrows dollars by swapping its local currency, euros, yen, for USD, promising to reverse the trade later. Repo markets: banks borrow dollars against collateral, often U.S. treasuries. Wholesale deposits and commercial paper, short-term instruments that roll every 7-90 days. In a healthy system, these are nearly frictionless. Before 2022, a Japanese bank might swap yen into dollars at a cost of 20-40 basis points per year. A 2% Treasury yield minus 0.3% hedging cost still produced a positive spread. Now consider the same trade in a 5% world. Assume a European bank buys a 5-year Treasury yielding 4.6%. To eliminate currency risk, it hedges via FX swaps. If the annual hedge cost is 2.5%, which has been common during periods of dollar stress, the net yield becomes 4.6%, 2.5%, dollars 2.1%. From that 2.1%, the bank still must cover capital charges under Basel III. balance sheet usage penalties, liquidity coverage requirements, operational and funding risk. After those costs, the economic return often falls below 1%. In some windows, it turns negative. This is the invisible tax on global dollar intermediation. So banks do what any rational institution does. They shrink exposure. They reduce swap activity. They allow U.S. assets to mature without reinvesting. They shorten tenor. They refuse marginal trades. Each individual decision is rational. Collectively, they tighten the system. Now here's where the feedback loop forms. When fewer banks provide dollar liquidity, FX swap spreads widen, dollar funding becomes scarcer, hedging costs rise further, more trades become uneconomic, more balance sheets retreat. This is not panic, it is math. A concrete example, suppose global banks intermediate $10 trillion in offshore dollar funding. If higher rates and regulatory pressure reduce that by just 5%, that's a $500 billion contraction in effective dollar supply. There is no central warehouse to replace it. The Federal Reserve does not directly supply offshore markets unless stress becomes extreme, and even then it does so selectively through swap lines. Meanwhile, the U.S. is issuing between 1.5 and 2.0 trillion in treasuries annually to fund deficits. Someone must absorb that paper. If foreign banks absorb less, domestic institutions must absorb more. But domestic balance sheets are finite. This is the part most people miss. High rates are not just restrictive for borrowers, they are restrictive for intermediaries. Every extra dollar of assets consumes capital. Every repo position consumes leverage. Every hedge consumes funding. At some point, the system does not want more assets at any price. When that threshold is reached, price stops being the only adjustment mechanism. Quantity adjusts instead. That means fewer loans, shorter maturities, tighter terms, and wider spreads. It shows up as commercial paper rates rising relative to Fed funds cross-currency basis moving against foreign borrowers, repo volumes, thinning trade finance becoming more expensive. None of these make headlines, but they change behavior. A manufacturer that used to roll a 90-day dollar facility at SOFR plus 40 basis points may now face a SOFR plus 110. An importer that hedged currency risk for 1% annually now pays 3%. Margins compress. Inventory cycles shorten. Risk tolerance drops. This is not a crash mechanism. It is a slow compression of financial oxygen. The system still functions, but at higher pressure. And systems under pressure become fragile. Every liquidity regime produces winners, losers, and, most importantly, actors who cannot simply wait it out. The current dollar tightening cycle is no different. The pressure does not fall evenly across the system. It concentrates on those who are structurally short dollars, structurally leveraged, or structurally time-bound. The first group under pressure is non-U.S. banks that built business models around cheap dollar access. European and Japanese institutions finance trade, energy flows, aircraft leasing, shipping, and emerging market credit in USD. Many of these books are long dated, 3, 5, even 10 years, while the funding rolls every 30 to 90 days. That maturity mismatch only works when rollover is cheap and predictable. Now it isn't. When hedge costs jump from 1% to 3%, a bank running a $50 billion book faces an extra $1 billion per year in friction. That cost is not theoretical. It hits earnings. It consumes regulatory capital. Boards respond by shrinking exposure. But they cannot unwind everything at once. Many positions are contractual. Many are politically sensitive. Many are embedded in client relationships. So banks are trapped between two options. Keep rolling expensive funding and accept structural margin erosion, or cut balance sheet and deny marginal credit. Either profitability erodes or global liquidity does. The second group under pressure is emerging market borrowers. Corporations in Latin America, Southeast Asia, and Eastern Europe carry an estimated $4-5 trillion in dollar-denominated debt. They do not earn dollars domestically. They rely on trade flows, FX markets, and offshore banks to access them. When dollar funding tightens, three things happen simultaneously. Their local currencies weaken. Their dollar debt becomes more expensive to service. Refinancing windows shrink. A firm that issued 5-year bonds at 4% in 2020 now faces 7% to 9% refinancing costs in 2026. If its revenue base is in local currency, that is not a marginal change. It is existential. This is where the binary choice emerges. Either global dollar liquidity eases or default risk rises. The third group is U.S. domestic institutions themselves. If foreign banks step back, U.S. banks, money market funds, and dealers must absorb more treasury issuance and more credit intermediation. But they are constrained by supplementary leverage ratios, liquidity coverage rules, deposit volatility, political scrutiny, a dealer balance sheet is not an infinite sponge. In 2019, a modest repo disruption over roughly $100 billion caused overnight rates to spike from 2% to nearly 10%. The system required emergency Fed intervention, not because of insolvency, but because balance sheets hit regulatory walls. That episode is instructive. The similarity, a technically solvent system experiencing a liquidity air pocket. The difference, today's scale is far larger. Annual Treasury issuance is measured in trillions. Offshore dollar exposure is measured in tens of trillions. Hedge costs are structurally higher. In 2008, the break came through credit losses. In 2020, it came through a dash for cash. In this cycle, the stress point is intermediation capacity itself. This is the part most people miss. Crises are not always caused by bad assets. Sometimes they are caused by not enough balance sheet. Everyone in the system is optimizing locally. Banks protect capital funds, protect liquidity corporations, protect cash governments, protect financing channels, but the system as a whole becomes brittle. Trade finance lines shorten from 180 days to 90. Credit spreads widen 150 basis points. Currency volatility increases. Inventory buffers shrink. Each move is defensive. Collectively, they reduce slack. The historical parallel is the 2011-2012 euro-dollar squeeze. European banks lost access to U.S. money markets. Dollar funding dried up. The Fed opened swap lines to prevent global seizure. The world did not collapse, but growth slowed, risk premiums rose, and policy space vanished. What's different now is scale and simultaneity. In 2011, U.S. rates were near zero. Today, they are near 5%. Back then, treasuries were scarce. Now, they are abundant. Back then, regulation was loosening. Now, it is binding. Either the cost of dollar intermediation falls, or the quantity of it does. That is not ideology, it is constraint. To see why this is structural rather than cyclical, we need to look at the flow math that underpins the system. Markets often behave as if liquidity is an abstract force. It isn't. It is the product of balance sheets expanding or contracting. Start with the U.S. government. Over the last 5 years, annual Treasury issuance has ranged between roughly $1.2 trillion and $2.3 trillion, depending on deficits and refinancing needs. Even in a calm fiscal year, net issuance now tends to exceed $1.5 trillion. That paper must be absorbed by someone: domestic banks, pension funds, insurers, money market funds, or foreign institutions. Historically, foreign holders have been critical. Non-U.S. investors hold approximately $7 to $8 trillion in treasuries, around 25% to 30% of the marketable stock. Even if their share remains stable, they must still roll maturities and absorb net issuance. If instead they reduce participation by just 5% annually, that implies $350–400 billion less demand in year one, $700–800 billion over 2 years, more than $1 trillion over a typical policy cycle. Now layer on the banking constraint. A large global bank might operate with a leverage ratio around 5% to 7%. That means every $100 billion of assets requires $7 billion in equity. If regulations or internal risk limits prevent that equity from being deployed, the bank cannot expand its book, even if the assets are safe. Suppose offshore banks currently intermediate $10–12 trillion in dollar assets and funding. A 5% contraction, driven by hedging costs and capital usage, removes $500–600 billion in effective dollar balance sheet capacity. That is not a flow. It is a stock adjustment. The system must then reallocate that capacity domestically or reduce activity. We can frame this in 3 simplified scenarios. Scenario A, absorption works, optimistic. Foreign pullback, 300 or 400B year. Domestic institutions absorb 70%, Fed balance sheet remains flat. Result, Treasury yields drift 25–50 BPS higher, spreads widen modestly. Growth slows but remains positive. This requires U.S. banks, funds, and dealers to expand balance sheets materially despite regulatory drag. Scenario B, partial fracture, base case range. Foreign pullback, 400–600B year domestic absorption, 40–50%. Remainder clears through price. Result, yields rise 75–125 BPS in stress windows, FX basis widens, credit spreads expand 100 to 200 BPS, trade finance tightens. Here, price must do the work that balance sheets refuse to do. Scenario C, hard constraint, stress case, foreign pullback, 500–700B year domestic absorption, 30%. Fed forced into targeted intervention, result. Repo volatility, funding spikes, policy pivot under market pressure. Notice what's missing: a scenario where nothing changes. The reason is arithmetic. You cannot issue $1.5 out to $2.0 trillion per year into a system whose marginal intermediaries are shrinking. The same math applies to corporate credit. U.S. non-financial corporates carry roughly $13 to $14 trillion in debt. A significant portion, $2 to $3 trillion, refinances over the next 3 years. If average interest costs rise from 3% to 6%, annual interest expense increases by roughly $2 trillion x 3% and $60 billion per year. That is not catastrophic in isolation, but it compounds with tighter bank balance sheets and reduced foreign participation. The marginal borrower becomes uneconomic. Liquidity does not disappear evenly, it retreats from the edge. Small banks first, then regional credit, then speculative grade borrowers, then cross-border finance. Only later, core sovereign markets. This sequencing creates the illusion that nothing is wrong until suddenly something is. This is why normal expectations fail here. We are conditioned to think in terms of demand for assets, but in constrained regimes, supply of balance sheet is the binding variable. The system does not ask, is this yield attractive? It asks, can I afford to carry this exposure? When the answer becomes no across multiple nodes, foreign banks, dealers, funds, the system must clear through higher prices of capital, not because anyone is panicking, because the math demands it. Structural liquidity shifts rarely announce themselves with a single crash. They propagate through markets in layers, often in ways that appear chaotic to observers who expect clean cause and effect. In reality, the reactions are mechanically logical. They just operate through channels most people don't watch. The first transmission point is always short-term funding. When offshore dollar supply tightens, it shows up in cross-currency basis widening, repo rates trading above policy commercial paper spreads, drifting higher FX hedge costs rising abruptly in stress windows. These moves are small in isolation, 10, 20, 40 basis points, but they alter behavior. A hedge fund that relied on cheap repo reduces leverage. A dealer widens bid-ask spreads. A bank shortens loan tenor. Liquidity becomes more expensive before it becomes scarce. The second layer is asset repricing. As funding costs rise, the required return on assets rises with them. That affects treasuries, term premium increases, corporate bonds, credit spreads widen, equities, discount rates rise, real assets, cap rates move. This is not a sell-off because of fear. It is repricing because the cost of carrying risk has increased. If a fund previously financed a $10 billion bond book at 2% and now faces 5%, its gross margin collapses. It must either delever or demand higher yields. This is where feedback loops form. Funding cost rises. Leverage becomes uneconomic positions are reduced. Prices fall, volatility rises, risk models cut exposure, liquidity thins further, funding becomes even more expensive. Each step is rational. Together, they produce nonlinear moves. This is why markets often gap instead of glide. It is also why correlations break. In a healthy regime, bonds rally when stocks fall. In a balance sheet constrained regime, both can fall together, not because growth expectations collapse, but because intermediaries cannot hold both. We saw this in 2022. Equities down 20% to 25%, bonds down 15% to 20%. The traditional hedge failed because the constraint was not economic. It was financial capacity. Observers often call this irrational. It isn't. It's structural. Another channel is market plumbing. As dealers protect capital, bid-ask spreads widen, market depth shrinks. Large trades move prices more. Volatility becomes self-reinforcing. An ETF that normally trades at NAV begins to show 30, 80 basis point discounts. Not because the assets are bad, but because no balance sheet wants to warehouse them. That divergence is a diagnostic signal. So are repo rates persistently above policy FX basis, staying negative for weeks, treasury auctions tailing repeatedly, credit spreads widening despite stable earnings, volatility rising without obvious news. These are signs of balance sheet stress, not panic. The market reaction also transmits into the real economy. Banks respond to higher funding costs by tightening lending standards, shortening maturities, raising spreads, reducing credit lines. Corporations respond by delaying capex, hoarding cash, reducing inventory. Passing costs forward, households feel it through. Higher mortgage rates, tighter auto credit, reduced availability of small business loans. None of this requires a crash. It produces a slowdown that feels mysterious. Why is everything tighter when growth looks fine? Because liquidity is not a sentiment. It is a resource. The most dangerous phase is the middle one, when markets oscillate violently without an obvious macro catalyst. Volatility spikes, then fades. Spreads widen, then compress. Commentators debate narratives. But underneath, the system is searching for a new equilibrium between the amount of debt being issued, the amount of balance sheet willing to hold it. Until that equilibrium is found, price action will look erratic. This is why people often misinterpret the first wave. They expect a headline event. Instead, they get a pattern: sharp sell-offs, fast rebounds, narrow leadership, thinning liquidity, rising tail risk. The structure is changing beneath the surface. When liquidity regimes shift, time compresses. What once unfolded over years now unfolds in quarters. The system does not fail all at once. It tests its limits in waves. Understanding the timeline is not about prediction. It is about recognizing structure. Think in 3 horizons. Next 24 to 72 hours. Markets probe balance sheet tolerance. You see it in treasury auctions, repo prints, FX basis moves, and intraday volatility. These are not trend signals yet. They are stress pings. When funding is abundant, these pings dampen quickly. When it is constrained, they echo. Next 1 to 4 weeks. Institutions adjust behavior. Dealers widen spreads. Funds reduce leverage. Banks quietly tighten terms. Volatility becomes episodic. Price moves feel disconnected from headlines. This is the regime where markets look nervous without an obvious reason. Next 1-2 quarters. The macro effects appear. Credit growth slows. Refinancing becomes selective. Capital expenditure weakens. Policymakers face trade-offs. Either liquidity is eased or growth decelerates. From here, 3 broad scenarios emerge. Scenario 1, base case. Controlled tightening structure. Foreign dollar pullback continues at a moderate pace. Domestic institutions absorb part of the load. Yields drift higher in stress windows. No systemic break. Market behavior. Treasury yields oscillate in a wide range, e.g. 4%, 5.5%. Credit spreads widen 50 to 120 BPS. Volatility remains elevated but episodic. Equity leadership narrows, confirming indicators. FX basis remains negative but stable. Repo rates hover slightly above policy and stress windows. Treasury auctions clear with modest tails. Credit issuance continues but at higher spreads. Bank lending surveys show gradual tightening. This is a world of friction, not collapse. Growth slows. Financial conditions remain restrictive. The system adapts under pressure. Scenario 2. Stress case. Balance sheet. Break structure. Offshore dollar contraction accelerates. Domestic absorption fails. Funding markets seize intermittently. Policy forced to respond. Market behavior. Sharp yield spikes followed by violent reversals. Repo and CP markets show gaps. Risk assets fall together. Liquidity vanishes in size. Confirming indicators. Persistent repo prints far above policy FX basis, widening beyond historical ranges. Repeated failed or heavily tailed treasury auctions. Sudden ETF discounts in core fixed income. Emergency central bank communication. This is not a credit crisis at first. It is an intermediation crisis. The system does not trust itself to clear. Scenario 3. Relief case, liquidity, re-expansion structure. Policy pivots or signals accommodation. Hedge costs fall, balance sheets re-engage. Dollar flow normalizes market behavior. Funding spreads compress, yield volatility falls. Risk assets reprice upward, credit issuance reopens. Confirming indicators, FX hedge costs decline materially. Repo trades align with policy treasury auctions. Strengthen credit spreads. Compress central bank language shifts from restraint to stability. This requires either lower rates, regulatory relief, or explicit liquidity facilities. The big picture takeaway is this: markets are not governed solely by optimism or fear. They are governed by the capacity of institutions to intermediate risk. When that capacity shrinks, price becomes the release valve. The modern economy is built on rolling short-term funding against long-term obligations. That structure is stable only when balance sheets are willing to stretch. High rates, regulatory drag, and currency risk reduce that willingness. Nothing breaks at first. It tightens, then it constrains. Only later does it fracture. Understanding this lets you interpret volatility not as noise, but as signal, an expression of a system searching for capacity.